There's no easy way to say this, but something is breaking in the US economy, and you're already feeling it, whether you realize it or not. In just the last few years, grocery prices are up over 30%. Credit card debt has hit a record $1.2 trillion, and the average American now needs nearly 40% more income just to afford the same lifestyle they had before 2020. At the same time, savings rates have dropped below pre-pandemic levels, while layoffs are quietly rising in sectors that used to feel untouchable. And here's the craziest part on paper. Everything still looks fine. The economy is supposedly growing, unemployment is low, and markets are still holding up. But if that's true, why does it feel like you're falling behind? Why does everything cost more, take more effort, and give you less in return? More Americans are starting to notice that something isn't adding up, and once you see it, you can't unsee it. Let me start with something that almost nobody is talking about, but once you see it, you can't unsee it. For decades, whenever things got scary, wars, recessions, crashes, money would rush into one place: U.S. Treasury bonds. That was the ultimate safe haven. Textbooks, economists, financial advisors all said the same thing. But here's the problem. That relationship is starting to break, and it's happening right now in 2026. Long-term Treasury yields have been rising even during periods of global uncertainty, which is the exact opposite of what should be happening. Normally, fear pushes yields down because demand goes up. But instead, we're seeing the 10-year Treasury hovering stubbornly high, even as geopolitical tensions rise and economic data weakens. That tells you something very important. Investors are no longer just worried about recession, they're worried about the system itself. And if you dig into the data, it gets even more concerning. Foreign demand for U.S. debt, especially from countries like China and Japan, has been declining for years. China alone has reduced its Treasury holdings by hundreds of billions over the last decade. At the same time, the U.S. government is issuing more debt than ever, running deficits exceeding $2 trillion annually. So now you have more supply and fewer buyers. What happens when supply rises and demand falls? Prices drop, yields rise, and borrowing becomes more expensive for everyone, not just the government. But you, me, mortgages, credit cards, everything. And here's the part most people miss. This creates a feedback loop. Higher yields mean higher interest payments on the national debt, which now exceed $1 trillion per year. That forces the government to borrow even more just to cover interest, which pushes yields even higher. It's a slow-moving pressure system building underneath the economy. And when people say something feels off, this is exactly what they're picking up on, even if they can't articulate it. Because for the first time in modern history, the thing that was supposed to be safest is quietly becoming a source of risk. The job market looks strong until you look closer. Now here's where things get even more subtle, and honestly, a little bit more concerning. Because on the surface, everything looks fine. You turn on the news, you hear unemployment is still relatively low. You hear job growth is resilient, and it sounds like the economy is holding up. But when you actually dig beneath the headlines, the story starts to change, and this is where more Americans are starting to notice that something just doesn't add up. For example, a huge portion of recent job growth has been concentrated in part-time work and lower-paying service sectors, while higher-paying full-time roles, especially in tech, finance, and corporate positions, have been quietly declining. In fact, data throughout late 2025 into early 2026 showed a rise in multiple job holders, meaning more people are working 2 or even 3 jobs just to maintain the same standard of living. That's not a strong labor market, that's a stressed one. And then you layer in AI, which is starting to replace not just manual labor, but white-collar roles, customer service, marketing, legal research, even parts of programming, and suddenly you have a structural shift happening that most people aren't prepared for. Companies are becoming more efficient, yes, but they're also hiring less. Add to that the fact that real wage growth, when adjusted for inflation, has been flat or even negative for many households, and you start to see the disconnect. People are technically employed, but they don't feel better off. And that's why consumer sentiment surveys have been declining, even when the official data says things are fine. Because people don't live in spreadsheets, they live in reality. They see their rent going up, groceries going up, insurance going up, while their income either stays the same or becomes less stable. And one more thing that doesn't get talked about enough: job security. Layoffs in sectors like tech and media have become more frequent and less predictable. And even people who are employed are starting to feel uncertain about how long that will last. So what do? They pull back spending. They delay big purchases. They become cautious. And when millions of people do that at the same time, it slows the entire economy down. So when you hear the job market is strong, you have to ask yourself, strong for who? Because for a growing number of Americans, it doesn't feel strong at all. It feels fragile. And that feeling is usually the first sign that something bigger is changing beneath the surface. The consumer is quietly breaking, and that's a bigger problem than you think. Here's something that should honestly concern you a lot more than headlines about stocks or even interest rates, and that's the American consumer. Because for the last 70 years, the entire U.S. economy has been built on one simple idea: people spend money. In fact, consumer spending makes up roughly 70% of U.S. GDP, which means if the average person starts pulling back even a little bit, it has massive ripple effects across everything. And right now, we're starting to see early signs that this engine is cracking. Credit card debt just hit an all-time high, surpassing $1.2 trillion. And what's even more alarming is that delinquency rates, meaning people falling behind on payments, are rising at the fastest pace since before the 2008 financial crisis. Auto loan delinquencies are also climbing, especially among younger borrowers, and buy now, pay later services are exploding in popularity, which sounds convenient on the surface but is often just another form of hidden debt stacking up behind the scenes. But here's where it gets really interesting, and honestly, a little scary. Retail sales numbers don't look terrible yet, but when you adjust for inflation, they're actually declining, so people are spending more dollars but getting less in return. That's not growth, that's survival spending. And if you look at where people are cutting back, it's very telling. We're seeing declines in discretionary categories like dining out, travel, and entertainment, while essentials like groceries, rent, and insurance are taking up a larger share of income than they have in decades. In some cases, households are spending over 50% of their income just on necessities. That leaves very little room for anything else. And when that happens, the economy starts to lose its flexibility. Add to that the fact that the personal savings rate has dropped significantly from pandemic highs, and many households have already burned through the excess savings they built up in 2020 and 2021. So now, instead of spending from a position of strength, people are spending out of obligation because they have to, not because they want to. And that shift is huge. Because once consumers hit a wall, once they can't borrow more, can't cut more, can't stretch any further, that's when spending doesn't just slow, it drops. And when that happens, businesses feel it. Layoffs increase, and the cycle feeds on itself. So when people say something feels wrong, what they're really noticing is that the backbone of the economy, the consumer, is running out of room to keep this going. Prices aren't just rising, they're being optimized against you. Now I want to talk about something that sounds almost crazy at first. But the more you look into it, the more real it becomes. And that's the idea that prices aren't just going up because of inflation. They're going up because companies are getting better at charging you more. And I'm not talking about basic supply and demand. I'm talking about algorithmic pricing, data tracking, and AI systems that are actively learning how much you personally are willing to pay. This is already happening across e-commerce, airlines, hotels, and yes, even grocery stores. Companies now collect massive amounts of behavioral data: what you click, how long you look at something, what device you're using, your location, your purchase history, and they use that to estimate your price sensitivity. So two people can look at the exact same product and see different prices, or different discounts designed to push them towards spending more. And this isn't theory, this is being studied and implemented at scale. In retail, dynamic pricing systems can adjust prices in real time based on demand, inventory, and even local demographics. That means prices aren't fixed anymore, they're fluid, constantly shifting to maximize profit. And when you combine that with industry consolidation, where a handful of massive corporations control large portions of the supply chain, you end up with a system where competition doesn't necessarily drive prices down the way it used to. Instead, efficiency drives profits up. And here's the part that most people don't realize. This creates a kind of invisible inflation. Because even if official inflation numbers start to cool, companies can continue increasing effective prices through smaller package sizes, reduced quality, hidden fees, or personalized pricing strategies. It's why you go to the store and feel like everything is more expensive, even when the data says inflation is under control. And then you add in things like subscription creep, where more and more services require monthly payments, and suddenly your fixed expenses quietly expand over time without you even noticing. So what ends up happening is people feel squeezed, but they can't always pinpoint exactly why. It's not just one big price hike, it's 1,000 small ones, optimized over time, and when you step back and look at it, you start to realize this isn't just inflation anymore. It's a system that's becoming incredibly good at extracting as much money as possible from the average person, without setting off obvious alarms. And that's one of the biggest reasons why more Americans are starting to feel like something is off, even if they can't fully explain it yet. What a lot of people still don't fully realize is that the middle class isn't just struggling right now, it's being fundamentally repriced in a way that's happening so gradually, most people don't see it until it's too late. Because if you look at the raw numbers, incomes have gone up over the last few years, right? On paper, wages are higher than they were pre-2020. But here's the catch. The cost of participating in normal life has increased even faster. Housing costs, for example, have risen so aggressively that in many major cities, the median home price now requires well over 40% of the median household income just to afford the monthly payment, far above the traditional 28-30% affordability threshold. Insurance premiums, especially home and auto, have surged double digits year over year in multiple states. Property taxes are rising as home valuations increase. Healthcare premiums continue climbing. And then you stack on childcare, education, and basic living expenses, and suddenly what used to be considered a comfortable income now feels tight. But here's where it gets more subtle. This isn't happening through one big shock, it's happening through constant small adjustments. A $50 increase here, a $100 increase there, a subscription added, a fee introduced, a deductible raised. And over time, those stack up to the point where households are allocating a larger and larger percentage of their income just to maintain the same lifestyle. This is what economists sometimes refer to as lifestyle inflation. But this isn't voluntary, it's systemic, and the data backs it up. The share of income spent on essentials has been trending upward, while discretionary spending is getting squeezed. That means fewer vacations, fewer upgrades, fewer financial cushions. And here's the part that should really get your attention. Upward mobility is slowing down. It's becoming harder to move from one economic tier to the next because the entry costs are rising faster than income growth, so people feel stuck. They're working, they're earning, but they're not getting ahead. And when enough people start feeling that way at the same time, you get a shift in sentiment. People start questioning the system. They start noticing patterns. They start asking, why does this feel harder than it should? And that's exactly where we are right now. Because the middle class isn't disappearing overnight, it's being compressed slowly, methodically, and almost invisibly. And once you see that happening, it becomes very hard to ignore. The system is quietly shifting from ownership to access. Now this next one is something that's happening right in front of us, but it's so normalized that most people don't even question it anymore. And that's the shift from ownership to access. Because if you think about it, the traditional path to building wealth used to be pretty straightforward. You buy a house, you own a car, you invest in assets, and over time those things appreciate or at least hold value. But today, more and more of those opportunities are being replaced with systems where you don't actually own anything, you just pay for the right to use it. Housing is becoming increasingly dominated by large institutional investors who are buying up single-family homes and turning them into long-term rentals. In some markets, institutional buyers have accounted for over 20% of home purchases, which reduces supply for individual buyers and pushes prices higher. At the same time, rising interest rates have made mortgages less affordable, effectively locking many people out of ownership altogether. Then you look at cars, leasing is becoming more common than buying, and even when people do finance, the loan terms are stretching longer and longer, sometimes 7 or even 8 years, which means you're constantly in a cycle of payments without ever really owning the asset outright. And then there's the digital layer: software, entertainment, even basic tools are moving to subscription models. You don't buy the product, you rent access to it. And while each individual subscription might seem small, collectively they create a constantly drain on income that didn't exist in the same way before. But here's the bigger picture. When you don't own assets, you don't benefit from appreciation. You don't build equity. You don't have something that grows in value over time. Instead, you're continuously paying into a system that extracts value from you without giving you a long-term stake in it. And that's a fundamental shift in how wealth is built, or more accurately, how it's not built. Because ownership is what historically allowed people to move up financially. And when access replaces ownership, that pathway becomes much narrower. So even if people can afford the monthly payments, they're not accumulating anything meaningful over time. And that creates a situation where people feel like they're running in place, earning, spending, repeating, without ever really getting ahead. And again, this is one of those things where people might not be able to articulate it exactly, but they feel it. They notice that despite working hard, despite doing everything right, the outcomes aren't what they expected. And that growing disconnect is exactly why more Americans are starting to realize something about this system isn't working the way it used to. Let's talk about something that sounds simple on the surface but is actually one of the biggest shifts happening right now, and that's the purchasing power of the dollar. Because most people think inflation is just prices going up, but what's really happening is much deeper than that. The dollar itself is quietly losing effectiveness as a store of value, and it's happening in a way that doesn't trigger panic, but instead creates a slow, constant squeeze on everyday life. Over the last few years, even when inflation numbers appear to cool down on paper, the baseline of prices has permanently reset higher. So even if inflation drops from, say, 8% to 3%, that doesn't mean things are getting cheaper. It just means they're getting more expensive at a slower pace. And this is where people start to feel like something is wrong, because their memory of prices doesn't match reality anymore. Rent doesn't go back down. Groceries don't reset. Insurance premiums don't reverse. Everything just stabilizes at a higher level, and your income has to catch up, except in many cases it doesn't. Now here's where it gets more interesting. The velocity of money, how fast money moves through the economy, has been unstable, and at the same time the total money supply expanded dramatically during the pandemic era. Trillions of dollars were injected into the system in a very short period of time, and while some of that has been pulled back, a large portion is still circulating. That creates a long-term effect where more dollars are chasing the same or even fewer goods and services. And then you add in global factors. Other countries are slowly reducing reliance on the US dollar in trade. Central banks around the world have been increasing their gold reserves at one of the fastest paces in decades, and alternative payment systems are being developed outside of traditional dollar-based frameworks. None of this means the dollar is collapsing tomorrow, but it does mean its dominance is being gradually diluted. And here's the key point. When a currency weakens over time, the cost of maintaining your lifestyle increases, even if your income technically rises. So you feel like you're making more, but you're not actually getting ahead. And that disconnect between nominal income and real purchasing power is one of the biggest reasons why people feel like they're working harder for less. It's not just perception, it's math. And once enough people start to feel that gap, it creates a broader awareness that something fundamental is shifting in the system. The everything bubble didn't pop, it's rotating and repricing. Here's where things take a turn that most people completely miss, because everyone is always waiting for a big crash, a dramatic collapse, something obvious, but what if that's not how this plays out? What if instead of everything crashing at once, the system is slowly rotating and repricing different asset classes one at a time? Because if you look closely, that's exactly what's been happening. Stocks had massive gains coming out of the pandemic, driven largely by liquidity and low interest rates. But now you're seeing increased volatility and a narrowing of market leadership, where only a handful of mega-cap companies are carrying the indexes while the broader market struggles. Real estate, which exploded in value between 2020 and 2022, is now facing affordability constraints, rising inventory in certain regions, and declining transaction volume even if prices haven't fully corrected yet. Meanwhile, alternative assets like gold and commodities have been gaining attention, not because they're suddenly more productive, but because they're perceived as safer stores of value in an uncertain environment. And then you have private markets, venture capital, private equity, where valuations are being quietly marked down, deals are slowing, and liquidity is drying up. So instead of one big pop, what you're seeing is a gradual rebalancing, where capital moves from one area to another, constantly searching for yield, safety, or growth. And here's the part that affects you directly. This kind of environment creates confusion, because there's no single narrative. One day the market is up, the next day it's down. One sector is booming, another is collapsing. And for the average person, it becomes very difficult to make sense of what's actually happening. But underneath that noise, there's a consistent theme. Valuations are being tested against a new reality of higher interest rates, tighter liquidity, and slower growth. And that means assets that were priced for a low-rate, high-growth environment are being adjusted to fit a very different set of conditions. Now, historically, periods like this don't resolve quickly. They can take years to fully play out. And during that time, you get cycles of optimism and fear, rallies and pullbacks, headlines that contradict each other. But the overall direction is clear. The system is recalibrating. And when that happens, wealth doesn't disappear. It shifts. It moves from one group to another, from one asset class to another, from those who don't understand what's happening to those who do. And that's why more Americans are starting to feel uneasy, even if they can't point to a single cause. Because when everything is moving at once, but nothing makes sense, that's usually a sign that the underlying structure is changing. The rules of money are changing, and most people haven't realized it yet. At some point, you have to step back and ask yourself a bigger question. What if the issue isn't just inflation, or housing, or jobs, but the actual rules of money themselves are changing in real time? Because when you look across everything we've talked about so far, there's a common thread. The old strategies that used to work are becoming less effective. Saving money in a traditional bank account used to be considered responsible, safe, even smart. But today, if your savings account is earning 3–4%, while real inflation, what you actually feel in housing, food, insurance, is closer to 6–8%, you are guaranteed to lose purchasing power every single year. That's not an opinion, that's math. And this is where things start to get uncomfortable, because it means the system is no longer rewarding caution, it's penalizing it. Meanwhile, asset ownership is becoming more concentrated. The top 10% of households now control roughly 90% of all stocks, and a significant portion of real estate gains have been captured by those who were already invested before prices surged. So if you weren't already in the market, getting in now requires significantly more capital, more risk, and more timing. And then you layer in financialization, where more parts of everyday life are being turned into investment vehicles, from housing to infrastructure to even data, and suddenly the line between living and investing starts to blur. You're not just a consumer anymore, you're part of a system where every action is monetized, tracked, and optimized. And here's the part that most people don't talk about. This creates a kind of forced participation. Because if you don't invest, if you don't take on risk, if you don't try to grow your money, you fall behind. Not slowly, structurally. It's like standing still on a moving walkway that's going in the opposite direction. You might feel like you're not moving, but you are just backwards. And this is why more people are starting to feel anxious about their finances, even if they're doing everything right, because the definition of right has changed. The playbook has changed. And unless you recognize that shift, you end up playing a game with rules that no longer apply. That's not just frustrating, it's destabilizing. And it's one of the clearest signs that something deeper is happening beneath the surface of the economy. This isn't one problem, it's a systemic transition happening in real time. So when you put all of this together, the weakening of traditional safe havens, the hidden fragility in the job market, the pressure on consumers, the rise of algorithmic pricing, the compression of the middle class, the shift away from ownership, the erosion of purchasing power, the rotation across asset classes, and the changing rules of money, you start to see something much bigger than any single issue. This isn't just a bad cycle. It's not just inflation. It's not just a slowdown. What we're witnessing right now is a systemic transition, and those are the moments in history where things feel the most confusing, the most uncertain, and honestly the most uncomfortable. Because during a transition, the old system hasn't fully broken, but the new system hasn't fully formed either. So you're stuck in this in-between phase where nothing feels stable, signals conflict, data doesn't match reality, experts disagree. And for the average person, it creates this underlying sense that something is off, even if they can't fully explain why. And here's the truth, this has happened before. Not in the exact same way, but in similar patterns. Think about the shift off the gold standard in the 1970s, the globalization wave of the 1990s, the digital transformation of the 2000s. Each of those periods fundamentally changed how money, work, and wealth operated. And during those times, there were winners and there were losers. Not because of luck, but because of awareness and adaptation. The people who recognized the shift early were able to position themselves differently. The ones who assumed things would go back to normal often got left behind. And that's the key takeaway here. Because right now there's a growing number of Americans who are starting to notice that the old expectations work hard, save money, buy a home, retire comfortably don't seem as reliable as they used to. And that realization is the first step. It's uncomfortable. Yes, but it's also where opportunity begins. Because once you accept that the system is changing, you can start asking better questions. You can start looking for where things are going, not where they've been. And that shift in perspective, more than anything else, is what separates the people who adapt from the people who struggle in times like this. So here's the reality. This isn't something that just fixes itself overnight. These shifts take years to fully play out, and most people won't recognize what's happening until it's already too late. But the fact that you're even watching this right now means you're already ahead of the curve. Because once you start to understand how the system is changing, you stop reacting emotionally and you start thinking strategically. You start asking better questions. You start positioning yourself differently while everyone else is still trying to figure out why things feel off. And that's really the difference. The people who pay attention early, who adapt early, who stay informed, they're the ones who come out ahead when everything else feels uncertain. So if you got value from this, do me a favor, hit the like button, subscribe if you haven't already, and share this with someone who needs to hear it. Because the more people understand what's actually going on, the better decisions they can make moving forward. And with that said, I appreciate you watching, and I'll see you in the next one.